Ladies and gentlemen, dear guests, welcome to the presentation of the inflation report, where we will give an overview of recent monetary and macroeconomic trends and set out our expectations for the period ahead. I believe that in the coming period too, we all want to see Serbia as a competitive and fast-growing economy driven by investment and exports as the key drivers of growth. We have no doubt whatsoever that this growth will continue in the described way, and what gives us reason for optimism is Serbia's potential for development, our reform-minded government, and the National Bank of Serbia's commitment to maintaining price and financial stability. Our optimism is also based on the results achieved thus far, including monetary and macroeconomic stability, robust fiscal adjustment, reduced external imbalances, and improved business and investment environment. These results were also recognized by numerous international institutions, including the International Monetary Fund, the World Bank, the European Commission, the European Bank for Reconstruction and Development, various rating agencies, and other globally renowned institutions. In contrast to them, some local critics ascribe the good results to a fortunate set of circumstances and often to measures taken by other central banks. Because of this, I want to underline today that we have achieved the said results relying solely on our own capacities, even though on that way we were faced with numerous challenges coming from the international environment. No one can refute the fact that inflation in Serbia has been low and stable for more than 2 years. Inflation in Serbia is around 2% and hence comparable to inflation in other European countries. That this is not due to a fortunate set of circumstances or to globally low inflation is shown by the experience of countries where inflation is still significantly above the target. High inflation in those countries is due primarily to macroeconomic imbalances and depreciation of their national currencies in conditions of volatile capital flows. Despite all these challenges, we managed to deliver both price stability and relative stability of the exchange rate. We managed to deliver and to maintain them owing to our well-timed and carefully thought-out measures that were coordinated with fiscal policy. As a result, we have had a significant reduction in internal and external imbalances, and you will hear the figures from my colleagues later on. In a nutshell, amounting to 3.7% of GDP, the budget deficit was almost halved last year, while the current account deficit was cut by 1/5 and was fully covered by foreign direct investment. In addition, the public often debates whether the noticeable fall in bank lending rates and the cost in government borrowing is attributable more to the monetary easing of the National Bank of Serbia or the European Central Bank. So let us answer this question, and I will give you nothing but facts. The fall in dinar lending rates began in September 2013 after the National Bank of Serbia initiated a cycle of key policy rate cuts in May that year. Since then, we have lowered the key policy rate by 7.5 percentage points to its record low of 4.25%. During that period, banks reduced their rates on dinar loans to the private sector by 10.1 percentage points to 8.8%, which is also their lowest level on record. And these are the facts. Lower interest rates also reflect competition among banks, which increased inter alia, as the National Bank of Serbia made sure that citizens have access to transparent information on lending terms offered by different banks. During the same period, though lesser than that for dinar loans, a decline was recorded for interest rates on euro loans by 2.8 percentage points to 4.4% in December, which is by all means due to the European Central Bank's monetary accommodation and the consequent fall in Euribor. There is no doubt, however, that this is also a result of Serbia's better macroeconomic performances and lower risk premium, and hence lower cost of borrowing for both the government and private sector. After cutting the key policy rate in its February meeting, the Executive Board of the National Bank of Serbia particularly underlined the expectation that further monetary policy easing will be followed by a further recovery of lending activity, which will contribute to investment. The 1.8% credit growth in 2015, in the face of maturing of 110 billion worth of subsidized loans, was beyond our expectations. New investment loans were 2 times higher than in 2014, while a significant rise was recorded also for loans that were refinanced under much more favorable terms. We expect these positive tendencies in the credit market to continue in 2016. Ladies and gentlemen, dear guests, what is certain, despite numerous uncertainties in the international environment, is that we will maintain monetary and financial stability and thus give a full contribution to sustainable economic recovery and prosperity of our country. I now give the floor to Ana Ivković to present the key messages from the February inflation report. And in addition to her, here with us today we have Milan Trajković, who will be ready to answer any of your questions. He's also coming from the Directorate for Economic Research and Statistics. To my right side is Vice Governor Veselin Pješčić. Next to him is Branko Hinić, whom you already know. And to the far right is Mirjana Miletić.
Thank you. I wish to thank the Governor for her introduction to the presentation of the February inflation report. Over the next 20 minutes, I wish to emphasize the length of my talk. As the Governor has already said, we will present current macroeconomic developments, our expectations for the period ahead, and the monetary policy measures taken in consideration of these developments. Movements in the prior period were consistent with our expectations stated in the November report. Inflation stayed low and stable, and GDP continued growing. These were our key expectations, and they materialized. As global prices of primary commodities declined in the meantime, inflation's return within the target tolerance band will be slower than expected before. According to the new February projection, inflation should return within the target tolerance band late this or early next year and move at around 3% thereafter. For the time being, GDP is expected to accelerate from 0.8% last year to 1.8% this and 2.2% next year. These are only projections. We have an entire year ahead of us. Taking into account movements in inflation, the National Bank of Serbia trimmed its key policy rate further in February by 25 basis points to 4.25%. As the governor said, this is its minimum level. Past monetary easing, begun in May 2013, has greatly reduced the cost of private sector and government borrowing. Since May 2013, the key policy rate was cut 16 times by a total of 7.5 percentage points. At the same time, it is in 2015 that interest rates recorded the sharpest drop so far, close to 5 percentage points. During 2015, the cost of government borrowing through issuance of dinar securities declined by around 4 percentage points. This decline was also supported by the continued narrowing of internal and external imbalances. As the governor said, the budget deficit was almost halved last year, from 6.6% to 3.7% of GDP, which confirms that we had a year of strong fiscal adjustment by 2.9 percentage points last year. The current account deficit declined by a fifth, to be more precise, from 6% to 4.8% of the gross domestic product, and it was fully covered by foreign direct investment. This coverage was 113.2%. Such narrowing of internal and external imbalances increases our economy's resilience to all shocks to which all other small and open economies are exposed. But even the largest economies are not immune to these influences. In that sense, late last and early this year, all economies were affected by movements in the international environment. Emerging markets in particular have faced challenges due to the Fed's monetary policy reversal and the strengthening of the dollar, which is why global growth forecasts have been revised downward. At the same time, euro area growth has continued at a moderate pace and is expected to reach 1.7% in 2016. Deceleration in emerging markets growth could, however, affect the recovery of the euro area by pushing down demand for euro area exports. Given its importance as our key trading partner, any potential slowdown in euro area recovery would affect our economy as well. Movements in the global oil market have also been volatile. After recovering temporarily to over $50 per barrel in early October, oil prices tumbled again in January to their 13-year low. They currently stand at around $30 per barrel, $30 to $35 per barrel. This is still a very volatile price, and it is over 70% lower than a year and a half ago when their slide began. On the left-hand chart, you can see the decline in oil prices. It was pretty steep, and the expected movements in the period ahead on the basis of futures, which also change. Although in our inflation projection, we assumed a certain recovery of such depressed oil prices on the basis of futures, downward pressures on oil prices may persist over the short run, mostly on account of persistently high supply and inventories and somewhat poorer prospects for global growth. In addition to oil, prices of other primary commodities also continue to decline, as you can see in the right-hand chart. All this has prompted central banks of the countries where inflation has been undershooting the target for an extended period of time to take measures in order to bring inflation back to target. In December, the European Central Bank decided to cut further its already negative interest rate on the deposit facility and to extend its quantitative easing program at least until March 2017 in order to support the return of inflation to target and sustain economic recovery in the euro area. In January, the ECB announced the possibility of further stimulus in March this year, after new macroeconomic projections are available. This would help moderate the negative effects of the Fed's so-called monetary policy normalization on capital flows to emerging markets. The pace of the Fed's rate hikes, however, may be slowed by weaker global growth prospects and the continuing slide in prices of primary commodities. So these are all uncertainties from the international environment, risks from the international environment, to which all economies are exposed, whether they are small or large. Such heightened uncertainty in the international financial market reflected on the domestic foreign exchange market as well. And while appreciation pressures on the dinar prevailed during most of 2015, depreciation pressures built up late last and early this year. In the first half of December and in January, pressures stemmed partly from increased investor risk aversion to emerging markets, Serbia included. To an extent, they were also generated by the interplay of seasonal factors at home. Factors working in the opposite direction included the already mentioned increase in foreign direct investment in Serbia, which in 2015 reached the amount of 1.8 billion euros, which is their highest level in the past 4 years, and they exceeded the current account deficit. Also, a successful completion of the third review under the IMF arrangement and Serbia's improved credit rating outlook have certainly had a positive impact on the perception of Serbia. Serbia's credit rating outlook has been raised by Fitch and S&P agencies. As before, the National Bank of Serbia kept a close eye on developments in the market and analyzed these developments and intervened in both directions by selling and buying foreign exchange in order to moderate excessive daily exchange rate oscillations and preserve financial stability. When it comes to economic growth, we can say that on the back of increased domestic demand, primarily investment, GDP increased by 0.2% in seasonal adjusted terms in the fourth quarter relative to a quarter earlier, and by 1.3% compared to the same period a year earlier. Investment determined GDP growth on the expenditure side, not only at the level of the quarter, but also throughout the entire last year. On the production side, growth was led by industry and construction. More than two-thirds of branches within manufacturing boasted increased production, while almost all branches recorded higher exports. Such trends are expected to continue, coupled with further acceleration in economic activity. After growing by 0.8% in 2015, GDP is expected to go up by 1.8% in 2016 and 2.2% in 2017. We expect growth in investment this year to result from an interplay of a number of factors, most notably lower operating expenses of businesses owing to more favorable lending terms and lower oil prices, as well as an improved investment environment. In addition, we expect that investment will also rise on the back of the recovery in the euro area, which is expected to continue, and stable inflow of capital from foreign direct investment. Favorable tendencies should continue in 2017. We expect investment to continue to drive economic growth. Household consumption will, in addition, probably be a positive contributor to GDP. There are risks to the GDP projection, and they are largely associated with the pace of economic recovery of the euro area and movements in international primary commodity prices. Inflation has been low and stable for more than 2 years, to be more precise, for 3 years now. Year on year, it continued below the lower bound of the target tolerance band in the fourth quarter and amounted to 1.5% in December. As in the prior period, inflationary pressures remained subdued on account mostly of the disinflationary effect of the majority of domestic factors, continuing slide in global prices of oil and primary agricultural commodities, and generally low inflation abroad. Looking ahead, year-on-year inflation is likely to stay low in the first half of the year, and we expect it to be lower relative to the November forecast projection, owing to a further decline in global prices of primary commodities, notably oil, over the past several months. According to our central projection, year-on-year inflation should rise moderately from mid-year and return within the target tolerance band late this or early next year. We estimate that its growth will continue in 2017, though at a much slower pace, averaging at around 3%. We expect that gradual inflation growth over the projection horizon, that is until end 2017, will mainly reflect the weakening of disinflationary pressures amid the assumed moderate rise in international primary commodity prices, domestic aggregate demand, and inflation abroad. There are risks to the projected inflation path, and they're mostly associated with future developments in the international commodity and financial markets, and to a degree with the speed of recovery in the euro area. Taking into account the latest inflation projection and all risks from the international environment, in its most recent meeting, the National Bank of Serbia's Executive Board decided to cut the key policy rate by 0.25 percentage points to 4.25%. This was the first key policy rate cut since October. The slower pace of key policy rate trimmings over the past months and the cautiousness this implies is attributable to heightened uncertainty in the international environment. In its most recent meeting, the Executive Board also decided to narrow the interest rate corridor by 25 basis points from ±2 to 1.75 percentage points relative to the key policy rate. This move should be conducive to further stabilization of interest rates in the interbank money market, as well as to the strengthening of the interest rate transmission channel. In addition, this month was the last in the 6-month cycle of the foreign exchange required reserve ratio cuts, which the National Bank of Serbia implemented to stimulate credit activity and, in turn, quicken the recovery of the Serbian economy. I would like to repeat what the governor said in her introduction, namely that lending activity increased in 2015 by 1.8%, despite the fact that high amounts of subsidized loans came due in the amount of around 110 billion dinars. A particularly favorable development is the fact that new investment loans granted in 2015 were 2.5 times higher than in 2014, rising from 88 to 223 billion dinars. We expect positive trends in the lending market to continue this year as well, as inflationary pressures are likely to stay low in the period ahead. The monetary policy stance of the National Bank of Serbia should remain expansionary, given the current prevalence of external risks. The degree of monetary expansion will depend primarily on the assessment of their potential inflationary effect. The National Bank of Serbia will continue to closely monitor developments in the domestic and international environment and to analyze these developments, and its future decisions will be consistent with a commitment to return inflation within the target tolerance band in a sustainable manner, while at the same time maintaining financial stability. If you do not have time to read the entire report, we would like to recommend that you read the overview and 5 exceptional text boxes which cover very topical issues. We now open the floor for questions.
Stojanovic, TVN1. I have 2 questions. The first one concerns the exchange rate. Early this year, I think that the interventions are much stronger than they were before. Is this a kind of an anomaly, or do you still claim that exchange rate movements are the same as in the previous year? And the second question concerns inflation. or what is it precisely that will push prices up, given that you said that electricity prices will not rise, that oil prices will not recover, that aggregate demand of households will be only 2.5%, investments will be delayed because of the elections. So what is it that made you say that inflation will rise? They usually tell me to answer all the questions concerning the exchange rate. And I think that citizens in Serbia are already used to the fact that the exchange rate is one of the most stable anchors, so to say, and that the National Bank of Serbia is one of the pillars of stability in the Republic of Serbia. This relative stability of the exchange rate has been achieved thanks to consistent interventions in the interbank foreign exchange market. We assessed the causes behind volatility. So when the causes are short-term, we respond, we intervene in the market, and I will repeat once again that we do not target any specific level of the exchange rate. But what you label as an anomaly, I think you're referring to January, was induced by seasonal factors because of the increased purchase of foreign exchange on account of energy imports. And it is also due to the disclosure of results of the special diagnostic studies, where banks disclosed the need to make not only certain provisions for non-performing loans, but also to strengthen their own positions by buying foreign exchange in the market. And we also have some lagged requests for the purchase of foreign exchange because some profit is taken out of the country without any legal restrictions. These profits were taken out of the country quite legitimately, and this was also one of the causes behind increased demand for foreign exchange. The National Bank of Serbia never intervenes in the foreign exchange market in order to stifle its functioning, but only supports its functioning by not allowing excessive fluctuations and the shocks that hit us from the international environment in terms of withdrawal of foreign investors because of, as you all know, because of the Fed's decision, because all foreign investors are set for the increase in the Fed's rate. And the National Bank of Serbia has, in accordance with its consistent and responsible intervention policy, from the reserves created in the past year, when quite unexpectedly we were faced with pressures, appreciation pressures, and when we ended up the year with 550 million euros higher foreign exchange reserves. So we were the buyers of foreign exchange, and we intervene in order to maintain relative stability of the exchange rate. And there is nothing strange about that. We will continue to assess the factors behind volatility, and in accordance with that, we will respond. Your second question is regarding inflation drivers in the coming period is something that I could leave to Milan to give you the answer, but I could also tell you quite openly that we will not allow inflation to rise through higher depreciation. I will have to disappoint all of those who believe that. I will gladly be an unsuccessful governor by having an inflation that is not within the target, and I will be in the ranks of other governors which account for 80% of inflation targeting countries where inflation is not on target. Milan will answer in detail this question. You noticed well that we projected relatively low growth of private consumption, but what you have to take into account is that this 1.8% growth will be led by domestic demand. What we expect is the neutral contribution of net exports and relatively low contribution of consumption, private consumption. So aggregate demand is low, but it is rising. And the second thing you mentioned, oil derivatives, petroleum products. For the time being, crude oil prices are rather low, but you have to take into account that any projection relies on certain assumptions. Our projection operates on the assumption of a gradual rise in petroleum product prices. They are expected to rise to $40 per barrel until the end of the year. So we expect a positive contribution from petroleum product prices relative to what we have now. Also, what I would like to add, and maybe this is going into too much detail, but in the first quarter, we will have a seasonally induced growth in fruit and vegetable prices. I hope I answered your question.
By asking Dick's question, you're imputing that there are certain conditions that will condition our intervention in the market. I cannot say for sure what will happen, but we will be a factor of stability in Serbia's economy, for sure. I would just like to add something relating to inflation. I would like you to understand, when we said that the projection will be lower relative to November, this does not mean that there will not be an increase in certain prices. So we assumed 1.1 inflation, euro area inflation, which has been adjusted to 0.8 in the meantime. So 80% of the countries are below the target. So this does not mean there will be no inflation, but inflation will be lower relative to the prior projections. We assumed that agricultural product prices would go up by 6%, but we adjusted this now to 3%. We expect that oil prices will rise to $40. So we do expect a certain growth, but to a smaller degree than projected in November. So there are downside and upside risk. You have already been able to see how volatile these prices are. Futures are changing from day to day, so we cannot make specific certain forecasts. So you can see that in the meantime, euro inflation has been revised. So we are behaving in the same way as other central banks. We are monitoring, keeping a close eye on developments. We will communicate about these issues with you. These are projections only, and no one can say for sure what will happen in these volatile conditions. We do not have a crystal ball. As the governor has said, we will try to answer all your questions as fully as possible. Subotic, Al Jazeera. Question for the governor. Several days ago, the head of the IMF mission said that the assessment of this review will be given only after the elections. You met this morning with them. Which message did they give to you, or what is your view of the developments over the next 10 days? And is the IMF concerned with regard to the elections? If we take into account the history from 2012, when they withdrew because of the elections, regardless of the history when the IMF suspended the arrangement due to the electoral cycle and due to the commitments that were undertaken but not fulfilled, there is no concern on our side or on the IMF's side. We are behaving as we would normally during the regular fourth review of the arrangement. We expect no concessions, no deferral of the deadlines. The National Bank of Serbia has fulfilled all its commitments under the standby precautionary arrangement, and the only difference compared to the regular fourth review of the arrangement is the communication of detailed reports relating to audit, related to the review. So the fifth and the fourth review will now go together, and the results of the fourth review will be subsequently communicated in order not to influence the electoral process. So this is the only difference. I believe that it is the greatest contribution of this government and the National Bank of Serbia, that the IMF is a partner of Serbia today, and I will have to say that we should not be, we should not shy away from accepting an extended friendly hand and the offered support to economic reforms and changes that are necessary in these circumstances. And this type of partnership also reflects a change in the attitude of the IMF with regard to all tasks that are ahead of us. When it comes to the National Bank of Serbia, I must say that this has made our tasks easier. The task of the government goes back for decades. When you mention structural changes, structural reforms, this entails serious changes, and this part of the job will be supported within the remit and legal authorities of the National Bank of Serbia. The IMF is not someone who sets tasks, who gives orders or directives. By contrast, we agree on what the best solutions are, and I also believe that this is one of the results we have achieved and the government has achieved. What is your impression? Are they satisfied with what you have fulfilled? Are they dissatisfied with what has not been fulfilled? I have no need to tell you about my impressions. You will hear this from them at the press conference, which will be held at the end of the mission. I think you were already able to hear that macroeconomic indicators are much better than expected. We stated this in the introductory speech, that budget deficit has been halved, that we have increased lending activity, that it increased even more than we expected, that we have a narrowing of all imbalances despite fiscal consolidation, and that these are really indicators which show that we are moving in the right direction. And what I can say as my impression is that the IMF has full trust of all economic policy agents, that we will not stop on our reform path, and that we will not try in any way to avoid our commitments. With regard to the pace, which depends on the complexity of the problems, I will not discuss the pace of these reforms, because I want to I do not wish to give advice to anyone, although our policies should be coordinated. I will not today talk about impressions, I will talk about facts.
Allow me to follow up on Marco's questions. I'm wondering how did the IMF react this morning, considering that the Minister of Economy did not attend the meeting and he's in charge of a ministry where the key problems lie, the restructuring of enterprises and the structural reforms and the right-sizing of the public sector. So key representatives of the government did not attend the meeting. And the second question concerns capital outflow. Could you tell us what is the volume of that capital outflow from the beginning of the year? I fully understand your curiosity and concerns, but really not a single member of the Serbian delegation who also attended that meeting. Nobody asked that question. Nobody wondered why Mr. Serdić was not there while Mr. Milan Trivunac was there. Mr. Serdić called us several minutes before the meeting and told us he could not come. But Milan Trivunac acted on behalf of the Ministry of Economy. And tell me, what kind of a state would that be where the future of a country in one part of the authorities would depend on a single person? You know, I have a weak heart, and what would happen if I didn't wake up this morning? Nothing would happen, because none of my colleagues, all my colleagues have access to all the information that I have too, so nothing is locked in any safe. So every leader of a team shares information with his associates, and if there is any priority, if there are several engagements at the same time, they agree on who is going to do what. So such a situation happened today, and you should not look for any hidden meaning in the absence of Minister Sertić. Milan Trivunac was an excellent representative of the Ministry of Economy during that meeting, and he advocated its interests. When it comes to capital outflows, we can tell you that we still do not have January data. Journalists often ask this question concerning capital outflow, and maybe we will communicate it later on, but this year we had an outflow of portfolio investment in the amount of 280 million euros. These outflows stepped up by the end of the year. But what we also have to say is that we have seen a change in the structure of financing. The government had no problems whatsoever. This was compensated for by borrowing. So in terms of financing, there were no changes. We did not see this capital outflow as anything out of the usual. And what global results for the region show is that in Serbia, this outflow in relative terms was significantly lower. In Serbia, in relative terms, this outflow was much lower than in other regional peers. So we can conclude that outflow in Serbia that we announced and that we expected, and which was also caused in part by the decision of the Federal Reserve that we cannot affect, was lower than in other countries. And let me remind you that investors remained faithful to Serbia because of reduced macroeconomic imbalances, and because of improved perception of risk. They did not come here because of Serbia, but because they felt that the fiscal adjustment is significant, and because of this, we do not expect any major changes this year. And the decrease in the current account deficit and the fiscal deficit makes us much more resilient to external shocks.
You mentioned that outflow accelerated late last year. I know you mentioned in January. So we already said that we do not have data for this month, because January is always a little bit specific with regard to inflation, GDP, capital flows. So we would not be able to give you specific information. So what we can say for sure is that it did not accelerate. So we can tell you about the direction of these flows. So they have not accelerated, but we will give you more detailed information with regard to January. We really do not have final data, so it would not be serious for us to come out with such data now. Gordana Filipovic. I wanted to ask you, why are you intervening today in the market? Why are you selling euros today? And also with regard to inflation's undershooting of the target for 2 years, why are you not adjusting the target corridor for inflation, the target tolerance band? Why is there still 4 plus minus 1.5%? Because it is realistic that inflation has been undershooting the target for 2 years and will probably continue to do so for the 3rd and the 4th year. The next thing relates to banks. I already asked this question regarding Poštanska štedionica, which has capital adequacy as at 31 March 2015, which had its capital adequacy declined by 10 percentage points. What did you order this bank to do as the regulator of the banking sector? We are intervening for the reasons that I specified in the answer to the first question when I mentioned the stability of the exchange rate. We are intervening in order to prevent large volatility. Answer to the second question, the first discussion with regard whether the target should stay at 4 plus minus 1.5% or whether it should be adjusted in line with the European Union or faster convergence to the European Union have been initiated today in the talks with Mr. Rove. And I must say that I am on the same side with regard to this, but We only considered the dynamics and the timing of the revision of the target, because I would have nothing to add to the arguments which you stated. If this is the medium-term target is impossible to achieve, and if these trends prove to be durable, then revisions should be made. Yes, when it comes to Poštanska štedionica, it did disclose lower capital adequacy compared to other banks. Poštanska štedionica has taken the burden of maintaining the stability of the financial system by taking over a part of exposures which were a burden for Poštanska štedionica under Lex Specialis, which we inherited, and we had the task to preserve the stability of the entire financial system. And in the prior government, there was a commitment and an agreement of recapitalization of Poštanska štedionica in view of this burden that it has taken over and the questions regarding its asset quality. This has not been done. This was not done for many reasons, and Poštanska štedionica, largely due to this as well, disclosed lower capital adequacy. But you have to accept the fact that international financial reporting standards are a matter of interpretation with regard to the manner of the implementation by all those who are required to implement them. So someone would call it embellishment, and someone just the manner of implementation of international financial reporting standards. And each of these banks has its own methodology of evaluating credit risk and also the manner of provisioning against these risks. And it is completely clear that total results of the process of special diagnostic studies have shown that the banking system in Serbia is well capitalized and highly liquid, which for us as a regulator is systemically important, and all other things are under the remit of the owner. The owner is the government through the public enterprise Pošta, and we expect that within the strategy for resolving this issue and the commitments taken as far back as 2010 under a financial arrangement with the World Bank, under which it was envisaged that the government would renounce its ownership of banks, that a strategy would be designed in line with this, that would be complied with as agreed before, and substantial financial resources have been received before in order to support the implementation of this restructuring. So there is no reason for concern with regard to 30 banks in Serbia's banking system. And there should be many banks, diverse banks, large banks, small banks, investment banks, those who are closer to retail users and enterprises, because it is only competition that can lead to cheaper services for clients, that is, consumers of financial services.
A month ago, you said that you were analyzing the policy mix implemented by the European Central Bank, and that you yourself will start implementing such a policy mix. Are you considering an adjusted set of measures for Serbia, and do you discuss that? And have you discussed this with the IMF? And when is it that we can expect such a move? Someone could say that we agreed on what your questions are going to be like. I'm pleased to say that Serbia has provided all the preconditions so that Chapter 17 economic and monetary policies can be opened, and that is the answer to your question. The Republic of Serbia, when it comes to monetary policy and economic policy, is fully ready to start these negotiations and does not need any preparations, any adjustments. We are considerably aligned with the policies applied by the European central banks. Sometimes we even go one step ahead and undertake obligations that we are not ready for. But when it comes to monetary policy, in October 2016, we will start submitting to the European Central Bank data on interest rates, on deposits and on loans, and we are not required to do so yet. In doing so, Serbia strives to be comparable by the level of by the quality of services that it provides to its citizens, and I want to assure you that all measures that we enact in this connection will be comparable and based on the best possible practice of the European Central Bank, but only to the extent possible. And why do I emphasize this? You know the system where you climb on the stairs and then you push away the ladder because the rules which apply to those who climbed high do not apply to those others. What is allowed to us with our size of the economy and the country for which many say would like to behave as large countries, I think that we do have the right to look at the best possible practices, and no sovereignty that closes us in the financial sense is needed. We are truly a small and open economy and should be that in every respect. We are not allowed to implement quantitative easing. We do not have the right to finance the state in any way. And this regulation, this rule, we do not mind this rule, but is conducive to the structural reforms Serbia needs to implement. And if I tell you that there is only one restraint or two that we will have to amend once we join the European Union, and these are changes that concern the law on the National Bank of Serbia. And these rules apply to the disposal of property. This is one of the few restrictions that is still not aligned with the ECB. We do not mind it, but our manner of work is to a great deal similar to the ECB's manner of operation, but the difference between the dinar and highly euroized economy must be overcome in a resourceful way, and I think and I hope that we are doing that successfully.
Another short question, please. You mentioned that the IMF has full confidence of everything you are doing. Why is the IMF reluctant to give its final assessment until the end of the elections and the forming of the government? Let me repeat this again. They do not wish to interfere with the electoral process in any way by publishing results, recommendations or deadlines, which can be used by anyone to take a one-sided view and consideration of these results. Let me illustrate this. If someone is able to take and treat as serious research according to which we are the weakest economy, taking into account these or other indicators as the most illustrative with regard to the achievement of a certain level of living standard. I'm talking now about the research that says that we are one of the weakest economies, where the only two indicators taken into account are inflation and unemployment. This is not an indicator of the overall standard of living, but it is a good example of how you can take statistical research out of context and use it, that is, abuse it. So in order to avoid misuse or abuse of reports and recommendations, the IMF took a professional approach, discreet approach to this issue and decided to come and visit us. They decided we should work as if we would in regular circumstances as they are, but they decided to wait with the report until end of May. Am I clear now? May I ask another question? Yesterday, Mr. Savic said in a television show that the National Bank of Serbia has met all its commitments to the IMF, but not with regard to the NPLs, and that the government and the central bank hope that faster economic growth will help resolve the issue of NPLs. Have you discussed this issue with the IMF, and when will these institutional activities of the Central Bank and the Ministry of Finance begin? Mr. Savic is present here. He did not say this. He did not say that we did not meet our commitments. I watched this TV show. There are activities pending with regard to this. All activities that we have undertaken, including those relating to the resolution of NPLs, have been met and are on time. Strategy action plan of the National Bank of Serbia have been adopted 2 weeks ago. We published guidelines for the implementation of the International Accounting Standard 39, which relates specifically to this matter and the problem that has been long in that has been created a long time ago cannot be resolved by a legal document or by a task force, but the task force is meeting all its commitments in due time, and one of the closing meetings of the International Monetary Fund will include the meeting with the task force for NPLs. Very soon the government will produce a legal framework for appraisers, which is a part of this overall problem. So I can tell you that there is no cause for concern. All agreed activities are being undertaken according to the agreed schedule. If there are no further questions, I would like to thank you for your attention, for coming here today. I wish you all the best.